Hello. This is Neuro AI. Let's get straight to it. Can you become a millionaire? Yes. Is it complicated? No. It is just math. Forget the gurus who scream about secret stocks, complicated strategies. The truth is much simpler. Today, we are going to break down the exact numbers you need to hit your goal. No fluff, no get-rich-quick nonsense, just a clear, actionable plan. We will use simple words and real examples. I want you to see that this is not a dream, it is a destination with a clear map. The single biggest question people have is, how much do I actually need to save? They get lost in a fog of advice and never start. We are going to cut through that fog today. Imagine knowing the precise dollar amount to set aside each month to reach $1 million. That's what we are going to figure out. This is not about winning the lottery. It is about building a system that works for you silently in the background while you live your life. Okay, let's talk about the formula. Don't worry, no wall of confusing algebra. We are keeping this very simple so you get the engine behind your wealth. The concept is called future value. It means how much your money will be worth in the future. The full formula looks complicated, projects. Forget it. Focus on 3 simple levers you can pull to change the outcome. Think of it like a machine with 3 knobs. You can turn any of them to get the result you want. First knob, monthly savings. The amount you put into your investment account every month. It's the fuel for your money-growing machine. More and faster growth. You have direct control over this knob. Turn it up to reach your goal faster. Small increases now. Big differences later. Second knob, time, years. It's how long you let your money grow. Time is your most powerful ally. Starting at 25 versus 45 shows a massive advantage. You can't go back. Start today. Third knob, rate of return, %. It's the yearly average growth rate. Savings might earn 1 to 2%. Low-cost stock index funds historically, 7 to 10% long-term. What does it take to get to $1 million? Let's say you are 35 years old and want to retire at 65. That gives you 30 years. If your investments earn an average of 7% per year, you would need to save about $750 every single month. That is it. That is the number. It might sound big or it might sound small, but it is a real number. It is a target, and having a clear target is the first step to actually hitting it. Now let's break down how we get to that number and how you can adjust it for your own life. Let's start with the long-haul planner. Imagine you are 25 years old and you want to be a millionaire by age 65. That gives you a 40-year timeline. You have a very long runway. To reach $1 million in 40 years with a 7% return, you would only need to save and invest about $382 per month. That is about $13 a day. For the price of a fancy lunch, you could be on the path to becoming a millionaire. Now let's look at a more common scenario. You are 35 years old, and you are getting serious about retirement at 65. This gives you a 30-year timeline. The runway is shorter, so you will have to contribute a bit more. To reach $1 million in 30 years with that same 7% return, you need to save about $820 per month. This is more than double the amount for the 40-year plan. Time is that powerful. Finally, what if you start later? Let's say you are 45 and you want to retire at 65. Now, you only have a 20-year timeline. The hill is much steeper. To reach $1 million in just 20 years with a 7% return, you need to save and invest approximately $2,100 per month. The amount has jumped significantly. Here's a simple comparison. This is why financial experts always sound like a broken record about starting early. The later you start, the more of your own money you have to use. Time is a luxury, and in the world of investing, it is the most valuable one you have. We have mentioned compounding, but I want to make sure you truly understand how this force of nature works. Albert Einstein supposedly called it the 8th wonder of the world. It's that important. Compounding is simply your money earning money. Then the money your money earned starts earning its own money. It is a feedback loop of growth. It is not a straight line. It is a curve that gets steeper and steeper over time. Imagine you invest $10,000. It earns 10% in the first year. I'm with soaring we and sorry. I'm with shower we. Shalkraborti Kromakinsomindi Tembwamambi. Sorry, show $1,000. You now have $11,000. Next year you earn 10% again, but on the full $11,000, so you make $1,100. Your new total is $12,100. That extra $100 comes from earnings on earnings, compounding. Now imagine this repeating for 30 years. Now imagine this repeating for 40 years. It becomes an unstoppable force. Let's look at the Millionaire plan year by year, saving $820 a month for 30 years. You personally contributed about $295,200, but your account balance will be $1 million. Over $704,800 is pure growth. It is money your money made for you. Show pie chart. In the final years, the growth is explosive. Your account could grow by $50,000 or more in a single year without extra contributions. This is why patience is the ultimate virtue in investing. Many people get discouraged in the early years. They check after 5 years and see little growth. The snowball is still small. They are building the base. The most dramatic growth happens in the last third of your timeline. Stick with the plan through the boring years to reach the incredible later growth. We have talked about time and savings. Now let's turn the third knob. The rate of return. This can feel abstract because you don't control it directly. It's determined by where you invest your money. Your rate of return has a massive impact on how quickly you reach your goal. Even a small change in average return can mean hundreds of thousands over your lifetime. Back to our 30-year plan. At 7% average return, you need to save $820 per month to hit $1 million. What if you were more conservative, 5%? Maybe you hold more bonds or cash. At 5%, monthly savings jumps to about $1,200. That's almost $400 more per month from just a 2% drop. Leaving money in a standard savings account which earns next to nothing makes building serious wealth almost impossible. Now the other side, 9% average return, historically higher, but possible with a 100% stock portfolio. At 9%, monthly savings drops to $559. Look at that difference. 7%, 9% cuts required monthly savings by over $300. How to get a higher return? Generally, by taking more risk. Risk means your account value goes up and down more dramatically. Stocks, higher potential returns and more volatility. Government bonds, lower returns, but more stability. For most people with a long timeline, a mostly stock mix and a low-cost index fund targets 7 to 9% average returns. You accept short-term bumps for long-term growth. Section 6. Your automatic millionaire system. Bortrumwansen, Alminer system, the 4 pillars. Knowing the numbers is one thing, actually doing it is another. The secret to success is not willpower. It is to build a system that does the work for you. An automatic system. Set it up once, and it runs on its own, making you wealthy in the background while you focus on living your life. This is how you turn your plan into reality without the daily stress. Pillar 1. The 50-30-20 budget. 50% needs, 30% wants, 20% savings, investments. Pillar 2. Automate your savings. Pay yourself first on payday. Section 7. Quick wins. How to find more money to save. Many people hear these numbers and think, that's great, but I don't have an extra $800 a month. I get it. Finding that money can feel impossible, but often the money is there. First, attack your big 3. Housing, transportation, food. Negotiate rent, refinance a mortgage, or switch to cheaper car insurance. Plan meals to cut grocery and takeout costs. These can free up hundreds a month. Second, audit subscriptions. Streaming, software, gym, boxes. Canceling a few can free up $50, $100 monthly. Third, use the envelope system for wants. When the cash is gone, you're done. Finally, put your next raise on autopilot. Increase your transfer by the same percent. Section 8. Common myths that keep you poor. Myth 1. You have to be rich to start investing. Backward. You invest to become rich. You can start with as little as $50, even $1. Habit beats waiting. Myth 2. Investing is gambling. Day trading is gambling. Long-term index investing is not. Over 20 and 30-year periods, markets have always risen. Myth 3. You need to pick stocks. Most pros fail to beat the market. Use low-cost index funds. Myth 4. Wait for a crash. Timing fails. Time in the market wins. Automate monthly. Section 9. Your first step today, a simple action plan. Step 1. Choose a brokerage. Vanguard, Fidelity, or Schwab. Don't overthink it. Open the account. This makes it real. Step 2. Set an automatic transfer on payday. If $800 isn't doable, start with $200 or $100. The key is to start the habit. Step 3. Make your first investment in a low-cost, broad market index fund, VTSAX, VTI, or FSROX. That's it. You are now an investor. You own a piece of the largest and most successful companies in the world. You have officially started your journey. Protect the system. Let it run. Do not interrupt it. Do not panic during dips. Trust the plan. Increase contributions when you can. In 30 years, you'll look back on this day as the most important financial decision you ever made. This is how you build a rich life.